Hello, everyone. This is the Free American Press with your host, Alexander Horat. Before we begin, if you could please subscribe and hit that like button, that would be great. So today we're having Kevin Wadsworth. He's the co-founder of NorthStarBadCharts. It's a company launched in 2021 offering insights into evolving market trends. Kevin's scientific and professional experience as a meteorologist has enhanced his forecasting skills in markets, trading, and he's an advocate of sound money principles. Hello, Kevin. We're happy to have you on the show.
Hey Alex, I'm quite impressed. You managed to get my surname right, and you pretty much got meteorology right in one go as well. So it's a bit of a bit of a struggle to introduce me for some people sometimes. So well done for that. It's good to be here.
Oh, that's awesome. We're really happy to have you here. So, this is going to be a very interesting week for gold and silver market. What do you think will be happening this week? Today, gold is at around 4,080 an ounce this morning, and silver is $50 an ounce about.
Yeah, sure. Well, gold and silver are hesitating at the moment because they have gold in particular has reached a number of its upside targets and has just completed a technical measured move to the $4,400 area. And so, with price being stretched from its moving average, that's another way of saying that the market has moved, a large distance in a relatively short period of time. So the technical charts are just confirming what we sort of know instinctively, which is that the price has just had a big move. And when you get big moves like that, you at least need some sort of pause, some sort of consolidation. Silver is actually more the price of silver is probably more useful to us at the moment in determining the short-term direction of the precious metals. I can share my screen and explain why if you want me to.
Yes, please do. That would be awesome.
Okay, right. Well, for those of you that aren't really familiar with technical analysis, I'll just start by saying that if you think that a technical price chart is just some kind of squiggles on a screen and they're completely useless for trying to predict the future, um, try and sort of rationalize this in your mind. The price action that you see here on the gold chart, this is the gold chart going back to the 1970s, as the price of gold goes up and down, what it's actually doing is it's reflecting everything that's known about gold and its fundamental thesis. So all the fundamental stories that you hear about manipulation or you hear about supply and demand characteristics or political problems or whatever, all of these are bullion banks and bullion bank buying, all of that is priced into the gold chart. So when you look at the latest point on the gold chart here, I'll just get rid of these two little red lines because we don't need them. When you look at the price of gold here, just over $4,000 an ounce, that's not just the price reflecting the current situation. That's the price reflecting everything that we know about the future. So that the price is we're pricing in certain things that are known about stuff that's going on, not just in the gold market, but in global economics and finance. So things to do with interest rates, for example, things to do with inflation. That's what gold is reacting to, and that's forward looking as well as reacting to what is actually happening now in terms of trades that are being placed, because the trades that are being placed are being done so based on forward-looking data. So if you want to analyze as closely as possible what is actually the fact of the matter in the gold and silver market or anything else, the price chart is as close as you can get to the truth of the story. And we all love a story and we all like a narrative as to why gold or silver or Bitcoin is going up or down or sideways. And that story, um, well, those stories, some of them are true, some of them are partly true, some are complete garbage. And trying to sift through that pile of information is really, really difficult. And you're kind of being pulled one way or the other. Do I believe this? Do I believe that? Well, like I said, the price chart, if you learn how to interpret the language of the price chart, then you can do away with all of those stories, all of those narratives. You don't need them because the price chart tells you everything that you need to know. What I mean by that is that, for example, you see this red cup pattern and then this smaller red cup pattern. Altogether, they make a cup and handle pattern. And all that is telling you is that the price of gold has spent a long time basing and then basing again below an important resistance level, $2,000. The moment it broke out above $2,000, we knew we should turn bullish, and we knew that the target was 2,750 or thereabouts, 2,680 on the Fibonacci extension level, 2,750 on that resistance line there. And so using this data, and if I just scroll all the way back to 1980, you can see that if we join the price in 1980 to 2011, where did the price hesitate back in late 2024? I'll tell you where it hesitated. It hesitated exactly at that line. Now, that line is something, and the reason for it's not voodoo, it's not some kind of pseudoscience. It's because all of the traders, the investors, and the algorithms that are trading gold, they're aware of that resistance level. So profits are taken at that level, the price pulls back. But if the environment is still bullish and still favorable, which we knew it was going to be, then the price eventually resolves upwards and it broke out above that resistance line. And that was another point at which you could say with a high degree of confidence that the price of gold was going to accelerate upwards. How much is it going to go upwards? Well, you see all these red arrows here. They're showing measured moves, classical measured moves. They're all the same size. And so when you get a breakout, you get a measured move, breakout, measured move, breakout, measured move. And we've just had a consolidation earlier on this year. And you remember we had a period of about 4 months, 5 months where the price formed a flag pattern. If I zoom right in onto the weekly time frame, you can see that flag. And when the price broke out of it, we had another measured move, and we've hit the measured move target somewhere in the region of $4,400, that kind of area. So we're hesitating. Now, what I said at the start was that price of silver is actually more useful to us right here. And if I just take a look at the silver chart, and I'm just going to choose a different view for the price of silver. Let me just make sure I've got the right chart here. XAU USD, and I'm going to choose this one. I'll tell you what, I'm just going to get rid of all the annotations on it. See if we can go all the way back to 1980. So I'm going to do the same exercise that we did with gold. So this is 1980 on the left-hand side, and this is 2011, the peak in 2011. So what happens if we join? Sorry, this I've got gold here. I meant to get silver. Sorry, I beg your pardon. XAG USD, and I'll choose that one. Okay, you can tell I'm doing this live now. So let me just get rid of these annotations and drawings. So as I was saying, if we do the same exercise as with gold, you can see, and I'll just pop the candle chart on there. You can see where did the price stop? Right on that resistance line. I'll go back to the line chart. There's the line chart there, 1980, 2011, and then of course the price has pulled back, so the line chart doesn't show it touching that line. But if we put candles on, you can see the price touch that line. So the price of silver is actually more useful to us at the moment because we're right up against that line. And what it's telling us is that if silver is able to punch through that level, which if we just put the line right on the tips of those candles, you can see it's somewhere in the region of about $55. And if we can move to the 56 area, then that would be a clear breakout. So because we're at $50, $51 at the moment, we are using this chart to help us answer the question whether gold and silver are going to move much higher now. Okay, so we could get a breakout in the next few days, next week or two. And if that happens, then we go much higher before coming back, because that level would have turned from resistance into support. So we could move much closer to $100, then come all the way back down in a big correction, which would likely tie in with something that is going on in the stock market. So that is one scenario. The other scenario is that this correction now continues for a longer period of time and gets a little bit deeper for a little bit longer before we get the breakout. So that's the two technical patterns that we're likely to see now. And for the time being, we have to assume that it's this one that you see on the screen. It might just pull back for a month or two, might pull back for several months. And a likely pullback area, there's strong support actually down near $35. So if this turns into something much deeper, then there's a significant support zone for silver down near the $35 area. So that's perhaps at the moment the more likely scenario until the moment we punch through that line. The moment we punch through $55, $56, then the upside scenario continues. But either way, whether we get the correction now or whether we bust through and get the correction later, either way, silver, in my view, is going all the way up to $200 or $300 in the next 10 years. And I can explain why that is, because first of all, if we look at the gold to stock market ratio, and I'm just going to explain how this works because I understand that a lot of people won't really understand what a ratio chart is or what it means. So if you look in the top left-hand corner, it says XAU, which is gold, versus SPX. That's the S&P 500 stock market in the United States. So it's gold versus the stock market. Now with the ratio chart, when the chart is going up, it means that the first thing there is outperforming, so gold. And when the chart is coming down, it means that the second thing in that ratio, stock market, is outperforming gold. So if it's going up, gold is winning. If it's coming down, the stock market is winning. Now look what happened in the 1970s. We had, or in fact, go back further all the way to the 1940s and 50s. The chart was coming down and down and down and down. That means the stock market is outperforming gold. Then it based, the market started to turn around, and then we broke out of this resistance level. And if I put some other indicators on the chart, I'm just going to put, just bear with me a moment. Okay, so what we've got on the chart now is, and I'm just going to make a slight adjustment here if I can. Right, so the green line on the chart is the 48 months moving average. So it tracks the average price over a 4-year period. And this sort of red and green splodgy thing is what's called the Ichimoku cloud. It's a Japanese technical indicator on a chart. Now, the way to use them is that when the price is above the green line and this splodgy green and red cloud, then we're in a bull market for the stock market. When we break down below them, we're in a bear market for the stock market and a bull market for gold. So what are we looking at? We're looking at a rotation towards gold in the 1970s, then a rotation away from precious metals towards the stock market in the period around 1980 when that occurred. And then from there all the way to 2000, there was a huge stock market bull market and a very long precious metals bear market. So the chart kept coming down. Precious metals were underperforming the stock market. Then what happened in the early 2000s is we broke out, the chart broke out to the upside. It went above the moving average, above the Ichimoku cloud, and that put us into a bull market for gold and a bear market for the stock market. And that carried on all the way to 2011, 12. And then we had another rotation, and that rotation was away from precious metals, commodities, and towards the stock market. And from 2012 until around about 2017, maybe 2018, the stock market was winning and outperforming gold. Now, ever since 2017, 18, the chart's gone sideways. It's gone up and down, but overall it's gone sideways. So once again, we formed a base here. And if I just put it on the line chart, it makes it a little bit clearer. We've formed a base and we're breaking out. And the chart is now above the moving average there, the green line, that's the 4-year moving average. We're above the Ichimoku cloud, that technical indicator, which you can see that red splodge. And we're also breaking out now above these red resistance lines. And the final one is that black resistance line. What it's telling us, what the technical chart is telling us, is that the market and the market participants are beginning to move away from stock markets and towards precious metals. Now, the stock market is still doing fine, priced in US dollars, but this is the stock market priced in gold.
Mm.
That's what this is. This is the gold chart versus the S&P. So it's gold versus the stock market. It's gold priced in the stock market, if you like. So the higher up it goes, the more stock market you can buy for an ounce of gold. It goes up and up and up. Your ounce of gold that was worth $2,000 would only have bought so many shares in the stock market. Well, now gold is $4,000. The ratio has gone up. So your gold coin is going to buy more of the stock market. And by the time gold is $10,000, you'll be able to buy much, much more of the stock market. This chart will be all the way up here somewhere. So that's what this tells us. Now, we can also look at a chart which also makes that very clear. And I'm just going to pull up this capital rotation. Whoops, let me try that again. Open list, capital rotation. Right. So one of the charts that makes this very clear is the Dow to gold ratio. And you might have heard people talking about the Dow to gold ratio. And I'll just get rid of that and I'll just zoom in. So what we're getting now is the fourth signal in 100 years. So the first signal was 1930 when the Dow to gold ratio broke down and the stock market collapsed and gold had to be revalued higher because, of course, gold was pegged, the value of gold was pegged at the time. I'm just going to put the 8-year moving average on here. So that's we're on a quarterly chart here. So that's 4/8 of 32. Let me just put 32 period moving average. There we go. So now the green line on the chart is the 8-year moving average. So we fast forward to signal number 2 in the early 1970s. The chart broke down again, and that was the stock market rolling over, priced in gold. So the stock market fell 50%, then gold doubled, and then it doubled again, and then it doubled again, and then it doubled again. And silver went sky high as well. So at the start of the 1970s, the price of gold was pegged at around about 30 or $35 or something. But if we ignore that peg and do the same exercise with silver, you see the exact same chart pattern and the exact same effect. And then, as I said, through the 1980s, the stock market did very well until we got to the year 2000. And then again, the chart broke down and we collapsed. The chart collapsed. And when that happened, the stock market fell over 50%, twice, in fact. The S&P 500 fell 50% in the year 2000, and then it fell more than 50% in 2008. So the stock market collapsed twice, and gold doubled, and then it doubled again, and then it doubled again. So hopefully you're seeing the pattern here that when you break down below the moving average, below the Ichimoku cloud, below support, what you're looking at is gold doubling, then doubling again, then doubling again, and the stock market going nowhere for 10 to 15 years overall. Now, we've already seen gold double. So, I've been showing people this chart for the last 3 or 4 years, saying that gold was going to double and then double again, then double again. Well, gold has already doubled. And this is why. This is what we call a capital rotation event. If I just show you my feed on X, and I just go to my profile on X and show you my pinned tweet there. It's actually had 4.7 million views now, which is a bit mind-blowing, but I tried to make this as visual as possible so that people would understand it. This is the evidence for capital rotation events. US money supply is in a bear market priced in gold, so is the US dollar index. Consumer prices, producer prices, currency in circulation, equal weighted S&P, the New York Composite, the Dow Jones, the Wilshire 5,000, the Russell 2000, the S&P and the NASDAQ are now breaking down into bear markets priced in gold. All of these things can happen, at various points in time. But when all of these things happen together, what you're doing is you're bringing together a confluence of evidence. If you're trying to diagnose a patient, you don't just take their temperature and tell them that they're dying of cancer. You take their temperature, then you run some tests, some blood tests, you give them an MRI scan, you take x-rays. You need all the confluence of evidence. my background is in meteorology and weather forecasting. If I was trying to do a weather forecast, I'll just lick my finger and stick my finger in the air and say, oh, the wind is coming from the north. It's we're going to get snow. Um, you need to look at satellite images. You need to look at what the air pressure is doing. You need to look at the wind speed and the wind direction throughout the atmosphere, humidity, all of these things. You bring them together. These days, you throw it into a supercomputer, and the supercomputer crunches the data, and it works out all of the evidence, and then it produces a forecast. So that's what we're doing here. We're bringing together all of the evidence to be able to say that one by one, as they turn red, the capital rotation process is continuing, and that will lead to eventually a capital rotation event. A capital rotation event is the final culmination of all of this, which is the stock market falling by 30, 40, 50%. That's your capital rotation event. The stock market hasn't done that yet, but all of the other pieces of evidence are pointing to the strong probability that that is what is going to happen. And each time all of these things happen, it leads to gold rising hundreds of percent and stock markets falling, depending on which stock market index you're looking at, whether it's the NASDAQ or the S&P or the Dow Jones or the Russell. Stock market indices fall sort of 50 to 80% over a 1 to 2 year period. And then it takes them many years to get back to where they were to start off with. And this is why, if we look at, I'll just also go back onto my X feed here, and I'll just show you something if I can find it. This chart here. Senator Loomis was talking about this being the year for Bitcoin and digital assets, but turned out she was sadly wrong. And the reason she was wrong, and the reason people make these stupid mistakes, and I don't use the term stupid lightly, but it's because they're not looking at the confluence of evidence. They're not looking at it scientifically. If they had been looking at it scientifically, you'd have noticed that tweet that I just showed you. I put it on my X feed over a year ago, all the way back here on the left-hand side of the chart. And I was able to say a year in advance that gold was going to outperform Bitcoin in 2025, even though most people sort of laughed at me at the time and said, don't be stupid, Bitcoin's in a bull market. There's no way gold can outperform Bitcoin. Well, guess what? It has. And all these, sort of Bitcoin maxis are sitting there scratching their head like this, going, well, what's going on here? Manipulation this and, manipulation that, coming up with 1,001 different reasons why Bitcoin has plunged compared to gold. None of that is true. The simple reason is capital rotation. It's because the reason gold has been able to do what it's done and completely outperform Bitcoin, even if Bitcoin goes up to 20% on this chart and gold comes down to, I don't know, 30%, which may happen, but the fact that gold has matched or outperformed Bitcoin during what is meant to be the most active part of a crypto bull market should be telling people something, but they're not looking at these charts. They're not looking at the evidence. They're not understanding what is actually going on in terms of the economy, in terms of the business cycle, the economic cycle, and exactly what the heck is causing all of this. So I don't really know what more I can sort of say on that. It's frustrating for me to see some of this stuff. And something else that people often say is that rate cuts are going to send the stock markets to the moon. Rate cuts are going to cause cryptos to go crazy. Well, look at what rate cuts did in the year 2000. The stock market fell 50% during the rate cutting cycle. Look at 2008, rate cutting cycle, stock markets collapsed. Look at the 1980s, rate cutting cycle, the stock market fell 25% back then. Even look at 2000 and sort of, I think that's 2020 there, rate cutting cycle, stock market plummeted. So, whenever you hear these narratives, these fairy tales, these rainbows and unicorns that people plaster all over social media, please, please, please learn how to check the truth of the matter, because the only way to find out if they're talking garbage is to be able to pull up a chart of rate cuts, the Fed funds rate, pull up a chart of the stock market, and you can see instantly within 60 seconds that they're talking out of their their backsides because it's just not true. And they're misleading young traders and investors who are piling all of their money into risk assets, thinking that a rate cutting cycle is going to automatically send Bitcoin and stock markets to the moon. Well, I'm not saying rate cuts always cause stock markets to plunge because they don't. There are other examples where rate cuts haven't caused the stock markets to plunge. But all I'm saying here is that rate cuts often do cause or often do go hand in hand with stock markets going down. And the reason for that is because it's not the rate cuts that are determining what the stock market does. It's the reason for the rate cuts. Why are they cutting rates? Is the environment good or is the environment bad? If they're cutting rates for the wrong reasons, then the stock market is not going to appreciate it because everybody realizes that it's a panic move by the Fed to try and shore up a hopeless situation. So there are good rate cuts, there are bad rate cuts, there are good economic environments, there are bad economic environments. And going back to the gold versus stock market chart and some of that evidence that we've just been looking at, um, we can say with some degree of confidence that this is not a good environment. Gold is in a bull market versus all the sectors in the S&P 500. And if I just show you what I mean by that, let me just get rid of some of these bits that we don't need. And I'll get rid of that. Right. So this chart is plunging, and I'll just put the 4-year moving average on. Let me just put that back on. So 48 period. Okay, the chart is plunging. That means that XLC, Communication Services, is in a massive bear market priced in gold. We're below the moving average, below the Ichimoku cloud. We're in a bear market priced in gold. XLY, that's the consumer discretionary sector of the S&P 500. That's broken down into a bear market priced in gold. Bounced off support, plunge. Just like all the way back here in the early 2000s in a huge bear market priced in gold. XLP is consumer staples. It's in a bear market priced in gold. It's collapsed. XLE, energy, is in a bear market priced in gold. It's plunging. XLF, financials, that's broken down versus gold. It's down 85% from the peak. So financials are down 85%. Oh, and I didn't mention, by the way, that the stock markets like the Nasdaq and the S&P have lost. Well, looking at the Nasdaq, looking at the Dow Jones, for example, it's down over 70% priced in gold from when it peaked 25 years ago. Let that sink in for a moment. The stock market's peaked priced in gold 25 years ago. Despite the rally in the stock markets for the last 10 years, they have not been able to recover all of their losses. And now we're in a bear market again versus gold. Here's healthcare in a bear market versus gold. It's plunged. If you were to measure it from the top to the bottom here, healthcare is down more than 50% priced in gold. XLI industrials, bear market priced in gold. Materials plunging. Materials are down nearly 60% priced in gold. In fact, from the peak, which, as I said, was 25 years ago, we're down nearly 80%. I don't think people realize this, Alex. It's, real estate. I mean, look at that. That is a terrible, abysmal, catastrophic chart. It's down continuously priced in gold for 25 years, and we're now down 65%. So if you think that buying houses and property is in itself, better than just buying a gold bar, then it's a lot easier and a lot less stress to have a gold bar to look after than it is to try and look after a property, even if you've got tenants in there. I've had tenants in properties myself, and I know the damage that they can do and the strife that you can get.
Yeah,
XL,
I just
yes,
want to
go ahead.
say that's definitely true what you say about tenants. And in Western countries, the populations are declining, so there's going to be less need for housing as that continues.
Yeah, to some extent, although the population in the UK has gone from 55 million to over 70 million, but that's not through our own birth rate going up. It's through legal, not illegal, but legal migration. So legal migration has increased the UK population by millions, not, as you say, not through natural birth replacement. So there, in the UK at least, there's a massive pressure on housing, and young people can't afford to buy a house in the UK because of that pressure. And some of that pressure comes from landlords buying up all the housing stock and pushing the prices up. Technology now is looks to be breaking down into a bear market priced in gold. This is really important because tech was the final sector that was holding out, but we are now below the moving average, below the Ichimoku cloud, and moving down. And tech is down from the recent peak, is down over 30% versus gold. And if you look at the peak back in the year 2000, tech is down something like roughly 70%. XLU is utilities, and utilities are down 83% priced in gold, and they are in a very nasty bear market. So I don't know. I know I'm sounding repetitive here. I'll just stop sharing my screen for a moment. Um, you know, people watch me on these podcasts and they say to me, "Well, Kevin, you say the same thing over and over again." Well, yeah, I'm going to keep saying the same thing over and over again because it's true. It's been true this year. It's true last year. It's true the year before. This is a capital rotation process, and we're quite a long way through it now. Gold has been outperforming stock markets overall for 25 years, despite the recent bounce over the last decade. And now stock markets are in a bear market priced in gold once again, a new bear market. So by the time this bear market is finished, stock markets could be down 90 to 95% priced in gold. What are people doing investing in stock markets? The place to be is gold, silver, commodities, oil, energy, because when gold is in a bull market, silver has its bull market and it'll outperform gold. The mining stocks will have a period of 2, 3, 4 years of massively outperforming gold and silver. So monitoring the mining stocks is really important. Things like the uranium sector, they will outperform gold for a period of time and make some massive gains. Things like lithium, that's starting to wake up again. Maybe the cannabis sector, maybe things like coffee, cocoa. You can monitor all these commodity charts and price them in gold. I'll just quickly share my screen and show people how to do that because it's really, really easy. And I think it's quite valuable thing to learn. So I'll just put my screen back on again, my screen sharing. Um, okay, pick Alexander, pick something, pick anything that you can trade. I don't care if it's a cryptocurrency or if it's a commodity or whatever it is. Just think of something.
Oil.
Oil, good choice. Okay, so we'll choose the US oil chart because um, the US oil, I'm just going to get rid of all of the annotations. Okay, so US oil, this is trading. I use TradingView, by the way, and you can get a free account on tradingview.com. Doesn't cost you anything, and you can do what I'm about to do on the free account. But if you pay a few dollars a month, you can get an account that has all of the technical indicators and all the fancy bits and pieces on it. But this is the price of oil going back to the 1800s. So what do we notice from the technical analysis point of view? Well, the first thing I notice is that if you draw a trend line on here, you've got what was a resistance level now acting as support. So we broke out of this red line and moved up to over $100, and now we're coming back down to support. But the point here um, is oil outperforming gold or not? So I'll show you how to find out. You just use the cursor. I'm using my keyboard and I'm moving the cursor down to highlight crude oil, and it automatically puts the little um, abbreviation for it up here. If you then put a slash, a forward slash, and then manually type XAU that's the abbreviation for gold. XAU is gold. And then use your cursor to move down and choose Oanda because that's the exchange that has the most price history. Some of these other exchanges don't have as much price history for the price of gold, and then just hit return. And what that gives you straight away is US oil priced in gold. US oil over gold. That means US oil priced in gold. So the price of oil in gold terms has been falling. Oil has been underperforming gold. And until we break out through this line that I've drawn on the chart, then there isn't really any technical evidence that oil is the better bet, because we could very well move up there and then, like last time, just come back down again. You can see that here we moved up, hit the line, came down, and so there's a resistance line forming there. And it often helps to put some horizontal resistance on the chart as well. So you put a horizontal line on the chart, and what you do is by eye, you look for a point where there are lots of sort of touches on that line. And I would argue that probably in this area around here, you're getting some reaction on that line, and the price is reacting to that line. So we've got two lines now, the red one and the black one. If we pass through them both, then that's some weight of evidence that something is happening. If I just put the monthly chart on there, get rid of the volume because we don't need it, and get rid of the moving averages because we don't need them, you can see that we've got that Ichimoku cloud thing there as well. So if the price breaks through that cloud and that resistance line, then you're onto something. Then there is something going on in the market that is suggesting that oil is likely to be in a more prolonged uptrend versus gold. And a lot of people use the gold to silver ratio as well. So you can use XAU USD, that's gold, versus XAG USD, which is silver, hit return. And what you get is let me just get rid of my drawings again. What you get is the gold to silver ratio. So it tells you whether you should be investing in gold or whether you should be investing in silver. We've got a resistance level, which is somewhere up there. And we've got some support, which is ultimate support, which is somewhere down there. But if we zoom in a little bit more, what we can do is put on a support line, and we've got a support line that we're just resting on at the moment. I can probably take that line back a bit further. No, that's probably about it. So in the short term, the gold to silver ratio is just starting to show signs of a little bit of a breakdown here. And what that means is that silver is or has been outperforming gold. So in the short term, at the moment, silver is probably the metal to own. As soon as we start to get this starting to track upwards again, then gold is holding its value better. But in a precious metals bull market, you'd expect this to drop quite a lot, because silver would, over the years, outperform gold, particularly after the stock market has had its drop. So if the stock market is going to drop significantly, silver outperforms gold to a large degree after that stock market drop. When the stock market starts to recover, silver outperforms gold. So we can use these ratio charts to help us decide which of two assets we should be positioned in. And that's how you do it on TradingView. You just literally type it in, and it helps you to. It's a roadmap, you know. I said to you before we started recording, you know, it's a roadmap, and you're kind of stumbling around in the dark if you don't have something tangible on the screen in front of you to guide you. And personally, I use these charts a huge amount. I wouldn't ever resort to using fundamentals or narratives or stories that I read on social media, you know, because most of them turn out to be completely false. I mean, I don't know how many times this year we're supposed to have had an alt season, and that just hasn't happened. You know, and people were calling for silver to go to the moon, or, you know, people have been calling for gold to go to $800 or something ridiculous. And both of those things are completely wrong. And the technical charts were able to show us that they were completely unrealistic, and have been able to guide us to exactly where we've ended up today.
Yeah, definitely. I really appreciate you sharing all that information. Question that I got from listening to all of that is, have people been getting just poorer if you look at the price of gold? Like we see, like in Western countries, they may get more money each year in dollars or whatever currency, but has real wealth been going down in relation to gold?
Yeah, well, there's a chart. You might not be surprised to hear there's a chart for that as well. So I'll share that with you if you just give me a moment.
Okay, that'd be great. Yeah.
Put my screen sharing back on, and let me just okay. So we'll go back to that list there, and I tell you what, I'll do it from scratch because it'll probably be quicker. So if we look at gold versus producer prices, and that will tell you how gold is performing against producer prices. PPIACO, that's producer prices. So if you um, do that, what it gives you is this chart. So when the chart is going down, gold is losing to inflation. When the chart is going up, gold is beating inflation.
Okay.
Gold is outperforming producer prices. So if you look overall back to, let's say, the 1960s and 70s, the chart has gone from down here to up here. So despite all of the ups and downs, the chart is moving from bottom left to top right. And so therefore gold is at least, at the very least, keeping up with inflation. And depending on where your starting point is, you could start at 1980 there. Um, Gold is slightly outperforming inflation since 1980. In fact, any that you could wherever you start on this chart, doesn't matter where you start, 1970 or 1980 or the year 2000, gold has outperformed producer prices. So, for a while, people were saying, "Oh, gold is a complete waste of time because it can't even keep up with inflation." That's when, in the year 2000, we were down here somewhere, and gold had not kept up with inflation since 1980. But now that time has passed and we're now in 2025, gold has more than made up for what it lost, and gold has now, since 1980, outperformed inflation. So if you hold fiat currency, of course, it's a very different story because what can you buy with $1 now compared to what you could buy with $1 back in 1970? I think I don't need a chart to for people to believe me that the US dollar has lost something like 97% of its purchasing power, or 95%. I don't know what the exact number is. It's at least 95% of the US dollar's purchasing power has gone. Um, and we can look at things like um, gold versus house prices. And if I just pull that chart up for you, and just imagine that you had been stacking ounces of gold instead of saving dollars in the bank, um, then this would be the result. So this is US house prices priced in gold. So from 1975 to 2024, houses cost the exact same price. Now the chart's fallen even further. So we're down here now. So from 1975 to 2012, well, let me try and explain it for you. Back in 1975, it would have cost you something like 218 ounces of gold sorry, 220 ounces of gold to buy a house. Well, now, today, it's 131 ounces of gold to buy a house.
Wow.
So if you're using gold, your house is much cheaper than it was in 1975. In fact, it's something like 40% cheaper. So this shows the power of gold over long time periods. And some people watching this will say, yeah, but what about Bitcoin? Because Bitcoin's gone up a zillion percent. Well, come back to me in 50 years if Bitcoin is still here, and we can have a discussion about that. Personally, I've got my doubts whether Bitcoin is still going to be here in 50, 60, 80 years. So, that's a different discussion. But certainly we can say with guarantee that gold is going to be here in the next 100 years, the next 500 years, the next 1,000 years. Gold isn't going anywhere. So gold and its ability to protect your wealth and for in particular periods of time to massively increase your wealth is very, very important. And this just illustrates that houses are cheaper now than they were in 1975 if you use gold for your currency.
Yeah, that's definitely pretty eye-opening to see how houses are cost less in gold now. So that's pretty interesting. I'd just like to take the time to share your website for everybody who hasn't seen it yet. Here it is, uh, North Star and Bad Charts, and you can actually join the website uh, with the plan here on the website right here, Premium or Premium Plus. Do you just want to tell the audience a little bit about what you do with your website?
Yeah, sure. We've got a Black Friday deal starting in a few days' time as well, which will run for over a week. So that'll give 50% discount for life, or for as long as you decide to stay with us. If you don't like it, then you can leave and get your money back. But the website is for long-term investors and short-term traders. We provide the roadmaps for gold, silver, commodities, oil. We do a podcast every week that covers over 100 different investable instruments. We cover cryptocurrencies, we cover commodities, everything basically. And we, as I say, we provide long-term guidance, long-term roadmaps using these ratio analysis charts to help people allocate in their portfolio so that they can outperform the standard 60/40 portfolio, and they can outperform the stock market. Or if people want to, they can follow our trades as well. We've closed a number of trades this year with good profits actually, and the last few trades have all closed with gains of more than 50%. So that's all good. Our gold position is doing really, really well. Long-term gold position, long-term silver position, long-term uranium position is up about 400% at the moment for Cameco, one of
Wow,
the
that's
uranium
really
miners.
good.
So these long-term positions actually often do better than the trades. I'm getting too old for trading and trade. Jumping in and out of trades. It can be stressful at the best of times, but when you know that you're in a gold bull market and a commodities bull era, you can make gains of hundreds of percent over just I don't know, 3, 4, 5 years, and that's probably enough for most people. So yeah, we cover all of that. So if you want to take a look, if you like it, great. If you don't like it, well, we'll give you your money back. So there's nothing lost there.
Yeah, that's definitely great, and how you've gotten such great gains. 400% is huge. So I also would like to recommend follow Kevin on his Twitter, or I mean X now. You can follow him here. So that's definitely a good thing to, and just check out his website as well. And I would just like to thank you, Kevin, for providing all this great information, these charts, and I just want to thank you for being on the show.
Okay, it's been enjoyable. I'm happy to come back anytime, but it's always enjoyed talking about charts. It's something I'm quite passionate about.
Yeah, that's great. We'll definitely want to have you on the show again in the future so we can get an update. Just thanks again for everyone watching. Please visit Kevin Wadsworth's site and please subscribe to the channel and leave a like. And thank you all again and goodbye. If you enjoy our content and want to keep seeing amazing guests and insightful conversations, please like this video, share it with friends, and subscribe to the channel. If you'd like to support the channel directly, you can contribute through Zelle or Venmo. Every little bit helps me continue bringing you interesting guests and great content. Thank you so much for your support.